If you want to become a profitable day trader, you definitely need to try this strategy. My routine takes less than 30 seconds. It's price action based and finds the best setups without thinking too hard. Everything starts with one question. Get this wrong and nothing else matters. I'm asking one specific question. Which way are the impulses moving? Look at this chart. See these waves? This move pushes hard to the downside. That's an impulse. Then price retraces a bit. That's a correction. Then another strong push down. The impulses are bigger than the corrections. That tells me we're in a downtrend, and I'm only looking for shorts. Now watch what happens when I mark the same structure on this chart over here. Impulse up, correction, then another impulse up. The correction stays smaller than the impulses, which means this is an uptrend, and I'm only looking for longs. Simple so far, but here's where most traders get destroyed. See this pullback right here? It looks scary. Price is dropping, momentum seems to be shifting, and your gut starts screaming, this is reversing, get out. Or even worse, I should short this. Don't. This is still just a correction. The impulses are still bigger, and the trend is completely intact. I have to remind myself of this constantly. I trade the impulse direction, not the correction. But there's a trap you need to watch for. What happens when a correction grows larger than the last impulse? Watch this example. Impulse down, then a correction starts, and it keeps going. Now it's bigger than the impulse that came before it. That's not a correction anymore. That's a potential trend shift. The moment I see that happen, I stop trading that direction until the market proves itself again. So before I think about levels, before I look for entries, before I check any indicator, I answer one question. Which way are the impulses moving? If I can't answer that clearly, I don't have a trade. I have a guess. But knowing direction alone isn't enough. You need to know where to act. Okay, you know which way to trade, but trade from the wrong spot and you'll get stopped out before the move even starts. You can't just enter anywhere. You need to know where price is likely to actually react. These are your key levels, the spots where price tends to bounce or break. Here's how I think about it. Price doesn't wander randomly. It moves toward these levels like a magnet, and then it either bounces or breaks through. Watch this. Price is approaching this zone from below. This area rejected price several times before, which makes it resistance. This is the location where I start paying attention. See that? Another rejection right at the level. This is where the trade starts to form. But here's the mistake I made for years. I'd identify a level, price would get close to it, and I'd just enter. No real confirmation, no trigger, just price is at the level, so it must be time to trade. That's not a system. That's just gambling with extra steps. The level tells you where, it doesn't tell you when. That's what the next filter is for. But there's something that makes these levels actually work. Notice how I'm finding these levels on a higher time frame first. I mark them on the hourly or 4-hour, then I drop down to my day trading time frame to look for entries. This keeps me focused on levels that actually matter. Not every minor bounce on a 5-minute chart. That means nothing. You've now got direction and location locked in, but you're still not ready to enter because you're missing the trigger. This is the thing that separates traders who guess from traders who execute. Your entry trigger. Something concrete that either happens or it doesn't. Watch this. Here's a downtrend. Price pulls back up into resistance. I'm watching, but I'm not entering just because price touched the level. I'm waiting for this. Bearish engulfing. The body of this red candle completely swallows the previous green one. And that's my trigger to get short. Or look at this setup. Price at support. Then I noticed this massive long wick. That's a trigger. Now I can act. The trigger itself doesn't need to be complicated. It just needs to be specific. Here's the rule I follow. If I can't point to the exact candle or pattern that told me to enter, then I didn't have a trigger. I had a feeling. And trust me, feelings lose money. Now here's something I learned the hard way. Sometimes your preferred trigger just doesn't show up. Price is at the perfect level, direction is clear, everything looks good, but that engulfing candle never forms. So I always have a backup trigger, a plan B. Maybe it's a pin bar instead. Maybe it's a break of a mini trend line within the correction. Something else that confirms the same thing. The pullback is ending and the next impulse is about to start. You need both primary trigger and backup. Otherwise, you'll end up forcing trades that aren't really there. You now know what you're looking for. A specific event, not a feeling. That alone will stop you from entering trades too early. But here's the problem. Even with direction, location, and a clean trigger, you can still lose. I did, consistently, until I added the next filter. This is where I stopped losing half my trades. Here's the truth. Price movement can lie to you. Volume doesn't. Watch this example. Price breaks above this level and it looks like a breakout. But look at the volume bar underneath. It's below average, nothing special. There's no real commitment behind this move. And what happens next? Price reverses. All those breakout traders are now trapped and getting stopped out. Now look at this one. Same situation. Price breaking through resistance. But check the volume, way above average. That's real participation, real commitment to the move. And this breakout holds. The rule is simple. I want to see above average or increasing volume, confirming the move I'm about to trade. If volume is weak or declining, I stay skeptical no matter how good the setup looks on the chart. This applies to your entry trigger too, by the way. If I get a bearish engulfing candle at resistance, but the volume on that candle is pathetic, I'm much less confident in the trade. Volume tells you whether other participants agree with your idea. If they don't, you're trading alone, and trading alone usually means losing. You are now reading something most traders completely ignore, but there's another layer of confirmation I need before I pull the trigger. This filter would have saved me thousands of dollars if I'd learned it earlier. I use 2 time frames, and that's it. The higher time frame shows me context, and the lower time frame shows me entries. If they don't agree, I don't trade. Let me show you what happens when you ignore this. Here's the 15-minute chart. Clear downtrend. Price pulls back to resistance. I get my trigger, a nice rejection candle. Everything looks perfect. But when I zoom out to the 4-hour, look at that. We're actually in an uptrend on the higher time frame. My resistance is just a pullback in a bigger move up. I'm trying to short right into a wave of buyers. That trade loses. Of course it does. The fix is simple. Before I enter anything, I check the higher time frame. If both time frames agree on direction, I take the trade. If they conflict, I walk away. No alignment, no trade. That's the rule. You can have the cleanest setup in the world on your lower chart, but if the higher one is screaming the opposite direction, you're not trading correctly. Okay, 5 filters down. You're already seeing more than most traders ever will. But we're not done, because even a fully confirmed setup can blow up if the math doesn't work. 6th filter is risk to reward. Listen, I don't care how beautiful a setup looks. If the math doesn't work, I don't take it. Before I enter any trade, I need 2 things figured out: where my stop goes and where my target is. The stop goes at the point where my idea is proven wrong. If I'm long and expecting a bounce from support, my stop goes below support. If price reaches that level, I was wrong about the trade. Simple as that. The target goes at the next level that could realistically cause price to reverse against me. The next resistance if I'm long, or the next support if I'm short. Then I measure the distances. If the distance to my target is smaller than the distance to my stop, the math doesn't work. I'd be risking more than I could possibly gain. I need at least 2 to 1 or better. Watch this example. Entry right here. Stop goes below this level. That's 20 pips of risk. Target is at the next resistance, over 60 pips of potential reward. This gives me around 3R. That math works, so I take the trade. Now look at this one. Same quality setup on the surface. Entry here, stop below. That's 40 pips of risk. But the next resistance is only 30 pips away. The setup looks good, but the math says don't touch it. So I pass. Okay, one more filter, and this one might be the most important. Final filter is you. Everything can be aligned, direction, location, trigger, and you can still sabotage the trade. Maybe you're tired, maybe you're distracted, maybe you just took a loss and now you're trying to make it back fast. Before I enter any trade, I ask myself one question. Does this feel like patience or desperation? The best setups jump out at me. I look at the chart and I know immediately. There's no forcing it, no convincing myself. The trade is either obvious or it isn't. If I'm hesitating, if I'm talking myself into it, if I'm revenge trading it, that's my signal to walk away. And if I'm not mentally right, stressed, frustrated, unfocused, whatever, I don't trade that day, period. You now see the market completely differently than you did 10 minutes ago. You're not guessing direction. You're reading impulses. You're not entering anywhere. You're waiting for the right location. You're not hoping. You're waiting for a trigger. You're not trusting price alone. You're checking if volume agrees. You're not fighting the bigger picture. You're aligning with it. You're not taking bad math. You're measuring before you risk. And you're not trading desperate. You're trading patient. All 7 filters have to pass. Not 5, not 6, all 7. So print this checklist and put it next to your screen. Consult it before every trade you take. Now, this is only the foundation video. If you want to go deeper and speed up your learning curve, watch this video next. And if you're ready to fit this into a full A to Z trading system, that's what our academy is for.